Welcome to One Touch Professional School. I trust we are all doing well. Great. This is a continuation of our discussions on financial accounting, paper 1.1. Today we are looking at chapter 10 that talks about control accounts. Now, if you quite remember, during our discussions under the books of prime entry, we did mention two basic forms of control accounts: the sales ledger control account and the payables ledger control account. Good. Why is there the need for one to prepare a control account? Now, this section seeks to throw more light on the reason behind the preparation of control account and the two basic forms of control accounts that an entity can prepare to act as a check on its accounting transactions. Good. So now, to the definition of control account. Now, a control account is an account in the nominal ledger in which a record is kept of the total value of the number of similar but individual items. Okay, we are saying that a control account is an account in the nominal ledger in which a record is kept of the total value of the number of similar but individual items. Great. Now, when you open your account, say receivables or trade debtors account or trade debtors ledger. Now, in the trade debtors ledger, you will see a number of debtors accounts. Okay, so a control account is kept of the what? Of the receivables of the entire organization. Okay, now that total account acts as a check on the individual. That is, if the individual balances in the respective customer's account is added up. Okay, when we add up the balances on the individual debtors account, it should be equal to the control account. If you add all the sales to the various customers, now when we aggregate it, it should be equal to the total of sales in the debtors control account or the receivables control account. Good. So the control account acts as a check, okay, on the individual debtors account. Okay, good. Now, what are some of the importance or advantages of control accounts? Now, control accounts are used for correcting or locating errors. Okay, when a control account is kept, it helps us to identify or allocate errors. Okay, good. Two, normally, the control accounts are under the charge of a responsible official, and fraud will have to pass the scrutiny of this person. So it also helps us to detect fraud. Okay, because if a control account is prepared, it becomes very difficult. Okay, it becomes very difficult that we may not unearth. Okay, it becomes very difficult that we may not unearth an error or a fraud that might have been perpetrated. Okay, because every single transaction that goes on in the respective debtors account will be tracked in the debtors control account. Okay, good. Now, for management purposes, the balances on the control accounts can always be taken to be equal debtors. Okay, for management purposes, the balances on the control accounts can always be taken to equal the debtors and creditors. That is, if you pick the total or the balances on the respective control account, be it sales ledger control account or purchases ledger control account, now the balances on this account can be taken to equal to the debtors and creditors without waiting for an extraction of the individual balances. Once we have the control account, when we add up or we extract the difference on the control account, now it's a true representation of the balances on the individual debtors or creditors balances. Do you get the point? Good. Therefore, we say that management control is aided for the speed at which information is obtained. Okay, one of the prerequisites of efficient control. Okay, good. And 4, control accounts can be used to ascertain missing balances. This is especially, okay, useful when an enterprise keeps what incomplete what records. So you can also use control account, okay, to obtain balances of the debtors and creditors, okay, especially in a situation where an entity keeps what an incomplete what set of what records. Good, good. Now, what are the principles that underpin the preparation of control accounts? Good. Now, the principle on which the control account is based is that if the opening balance of an account is known, together with information of additions and deductions entered in the account, the closing balance can be what calculated. So if you have information about the opening balance of a transaction and you have information on the additions and deductions during the period, now once this is known, we'll be able to determine the closing what balance. Now applying this to a complete ledger, the total of opening balances together with additions and deductions during the period should give the total of closing what balances. Now let's look at an illustration here. Good. Now what we are saying here can be illustrated in this way. So assuming you have sales ledger balances, okay, we are saying that if you have the opening balance, okay, add the total of entries which increase the balance. Any transaction that resulted in an increase in that sales ledger balances, add it, okay? Then you less the total of entries which have reduced the balance. Any transaction which will result in a reduction in the debtors figure should be deducted. Example, cash received from customers, goods returned by customers, okay? Discounts allowed to customers, okay? Now, all these things will reduce, and some of the things that will increase the debtors balance or the sales ledger balance is when sales is made to various customers, okay, or where a customer is charged for unduly delaying payment. So interest on overdue debt may also increase the sales ledger balance, okay, or the debtors balance, okay. Good. Now, because totals are used, the accounts are often known as total accounts. Thus, a control account for a sales ledger could be known either as sales ledger control account or as total debtors account. Similarly, a control account for purchase ledger control account could be known either as the purchase ledger control account or as the total creditors account. Okay, good. So either you hear sales ledger control account or total debtors account or purchases ledger control account or total creditors account. They all mean the same thing. Okay, they all represent the same item. Good. Now, information for control account. Now let's look at sources from where we can get information on debtors and information on creditors to aid us in the preparation of the control account. Now, a typical example for sales ledger, okay, sales ledger control account. What are some of the sources from where we can get information to obtain the total debtors account? Now, we talk about the opening debtors. Now, we are saying that the list of debtors balance is drawn up at the end of the previous period. So, if you go into your general ledger, okay, now you will see information on debtors. That is individual customers, okay, ledger account. Now, when you add up the balances of the previous accounting period, the closing balances, now that becomes the opening balance in the ensuing year. So when you pick the individual balances settled on the various customers' accounts and you add up, you get information on the opening debtors. Now, the source from where we can get information on credit sales, okay, is from the sales journal, the sales journal or the sales day book. Okay, good. We'll get information on credit sales. Now, don't forget the debtors control account and creditors control account. We are looking at credit transactions, credit purchases, credit sales. These are the transactions that are recorded in the control account. It does not take account of cash sales and cash purchases. So that's why we are referring to them as debtors control account and the creditors control account. Okay, good. Now, information on return invoice will be found in the return invoice journal or the return invoice day book. Okay, good. For checks received, Okay, when you go into your cash book, the bank column under the receipt side, you should see an information on the amount of check or the amount of money paid into the bank account by your customers. Now, if your customer also comes to pay fiscal cash, in your cash book at your debit side or your receipt side, you should see evidence of the cash received from the customer. Okay. Now, closing debtors information could be found in the general ledger. Again, the balances sitting on the respective customer's account, when added up, becomes the closing debtors balance. Okay. Good. Good. Now, for purchases ledger control accounts, now it's about credit purchases. It's about returns outwards. It's about discounts received. Okay, great. So for purchases ledger control account or total creditors account, we also obtain information about opening creditors. Okay, from the previous year account. Then under the general ledger, you will see information on what purchases ledger or creditors balances, where you see the respective suppliers from whom the business bought goods from. The account will be there. So when you sum up the balances sitting on their accounts, they become the opening balance for the current period. For credit purchases, we will obtain information from the purchases journal. For return outwards, we get that information on return outwards of journal. I believe and trust that we've not forgotten our day books very soon. Okay, good. So it's a continuation. Okay, good. Now, we will obviously would have to pay our suppliers for the goods we bought on credit. So information on cash payment will be found in the cash book. Okay, either at the bank column or the cash column. Cash column, that's when we pay our creditors in cash. And the bank column, that's when we pay our creditors in check. Okay, good. Right. Then other information on closing creditors will also be found in the general ledger on the respective suppliers account. Okay, good, good. Now to the forms of control accounts. Forms of control accounts. Now, control accounts are often presented in the same form as an account, with the totals of the debit entries in the ledger on the left-hand side of the control account, and the totals of the various credit entries in the ledger on the right-hand side of the account. So the control account just looks like a normal T account. Okay, good. Now that to the types of control accounts that we'll be looking at this chapter, we have what is called the sales ledger control account, or what is called as the total debtors account, and we have what is called the purchases ledger control account. The purchases ledger control, also known as the total creditors account. Okay, good, good, good. All right, all right. So now let's look at the formats. How does a sales ledger control account look like? Now, the sales ledger control account is the same as debtors. Okay. Now, don't forget that debtors have a debit balance. Debtors have a debit balance. Okay, good. So anything that increases this account must be debited, and anything that reduces the debtors balance should also be credited. So we see our sales ledger control account here. We have our opening balance. We have credit sales. We have refund to customers. We have bad debt recovered. We have interest on overdue debt and dishonored checks. Okay, on the credit side. Okay, now ordinarily debtors will have a debit balance, but we happen to have a credit balance. Now there will be a credit balance when a customer has made a deposit with the company to supply them with goods, which the company has not done yet. In that case, we will rather be owing the customer. So when the customer makes a deposit with the company, okay, now that will be a credit balance. That is, we are yet to supply the customer with the goods. Okay, good, good, good. Now, when a customer comes to pay, don't forget that we will debit our cash book, so we need to credit the customer's account. That's why you see bank, that is checks received, and cash, that is when the customer pays us in cash. Okay, good, good, good. So we have set off. Don't forget that under the tables we spoke about contra entry or set off. That is where a customer is at the same time a supplier, in which case they may agree that whatever debts, okay, that is owed each other is agreed on and settled, and any difference paid. Okay, good, good. So that's the typical format of a sales ledger control account. Okay, good. That's how a purchase ledger control account looks like. And this is how a purchases ledger control account also looks like. Now, purchase ledger stands for trade creditors. So ordinarily, they will have a credit balance. Okay, so why do they have a debit balance? They may have a debit balance when we have also overpaid them, or we have made some deposits to our suppliers and they are yet to supply us with goods. In that case, our suppliers will be owing us. Okay, so that it becomes a receivable from them. Okay, good. And when we buy, purchases will increases the account. That's why you have credit purchases at the credit side of the account, because a liability, when you are indebted to your creditors, you owe them. Okay, so it's a debt. Good. So these are some of the transactions that affect the supplier's account or the purchase ledger control account. So we have credit purchase, we have refund from suppliers, we have dishonored checks, we have interest on overdue creditors, then balances, the debit balance I've explained. That's where the company makes a deposit with their suppliers, yet for the suppliers to supply them with goods. In that case, the suppliers will be owing the company. Okay, good. All right. Then we have discount received, cash paid, we have bank check paid, we have bank return outwards. So when the company returns goods to the supplier, maybe it's not of the right type, the goods are stored, and what have you. Now that will reduce the amount of debt that the company owes its suppliers. Okay, when the company pays cash or check, now when the company pays, they will credit their cash book, so they need to debit the purchase ledger control account. That's why you see it's debit here. Okay, good. Now, balancing and agreeing control account with receivables and payable ledgers. Okay, good. Now, the control account should be balanced regularly, at least monthly, and the balance on the account agreed with the sum of the individual debtors or suppliers balances extracted from the receivables or payables of ledgers respectively. It is one of the sad facts of an accountant's life that more often than not, the balance on the control account does not agree with the sum of balances extracted for one or more of the following reasons. So there are instances where when you add up the balances in the individual customers or individual suppliers account, that balances will not agree with the total debtors or the total suppliers account. Now, when that happens, what do you do? Okay, when that happens, there may be instances where the balances on the control account may not agree with the balances on the individual balances or individual debtors or creditors account. So there is the need for this reconciliation or checks to be done. Okay, so it is often one of the sad facts of an accountant's life that more often than not, the balance on the control account does not agree with the sum of balances extracted for one or more of the following reasons. One, an incorrect amount may be posted to the control account because of a miscast of the total in the book of original entry. That is adding up incorrectly the total value of invoices or payments. Okay, the nominal ledger debits and credit postings will then balance, but the control account balance will not agree with the sum of the individual balances extracted from the receivables ledger or payables ledger. Now, a journal entry must then be made in the nominal ledger to correct the control account and the corresponding sales or expense accounts. Okay, good. Again, there could be transposition error. A transposition error may occur in posting an individual's balance from the book of prime entry to the memorandum ledger. That is, a sale to C of 250 might be posted to the account as 520. They have transposed the amounts, and that might cause a difference. Okay, that might cause a difference in the account. Okay, good. That's another thing. Now, let's look at other reasons. Now, a transaction may be recorded in the control account. Okay, a transaction may be recorded in the control account and not in the memorandum ledger, or vice versa. this requires an entry in the ledger that has been missed. That has been missed out, which means that a double posting if the control account has to be corrected, and a single posting if it is the individual balance in the memorandum ledger that is what at fault. Okay, good. So there may be so many reasons why the balances on the control account, okay, the balance on the control account may not agree with the individual balances, okay, on the respective debtors and creditors balances. And these are some of the reasons. Good. Now let's pick some questions. Let's pick some questions. Let's pick some questions. Let's pick some questions quickly. At least we need to solve about 4 questions on this. Okay, so let's look at this question. Question 14. Let me. Okay. So let's look at this question, question 14. Extracts from the books. Okay. Good. So I've extract from the books of AB Limited show the following balances for the month of September 2012. We have sales ledger balance as of 1st of September 2012. Under the sales ledger of debits and have credit balances. For the purchase ledger balances, that is also 1st of September 2012. We have debit and credit balances as well. And we have total for the month to 30th September 2012, purchases on credit, sales, among other things. Now, what's the requirement? Prepare the sales ledger control account, purchase ledger control account for the month ending 30th September 2012. Okay, and state 2 advantages of preparing control accounts. Good. So let's look at this. We have to prepare the sales ledger control account. So we have our sales. The sales ledger control account. Okay. And the sales ledger control account. And the sales ledger control account. We also have the purchases ledger. Okay. So transactions are in cedis. So let's put our cedi signs here. Okay. So the sales ledger, we have balances are 1st of September. That's the opening balance. Okay. So we come here, balance brought forward. Okay. Now this is 2012. This is 2012. Okay. This is 2012. This is 2012. Good. So the balance brought forward on the sales ledger, the debit balance is 25,400. Okay. Now the credit balance, that's the balance brought forward, is 500. Now let's do same for the purchases ledger. The balance, the debit is 400. Okay, it's very rare that we will give money to our suppliers before they supply us with goods. That's why the amount is so small, because ordinarily the purchases ledger should be credit balance. So you can see the credit balance is 250, meaning that we owe our suppliers so much. If you look at the sales ledger, our customers owe us 25,000, and only 500 has been deposited with us that we are yet to supply them with goods. Okay, good. Now you come to the transaction during the period. Now we have purchases on credit. Now we know that purchases on credit will increase the purchases ledger control account, or will increase the suppliers balance. So credit purchases will be credited to the purchase ledger control account. Why? Because when we buy, okay, we debit our purchases account, okay, and we credit the suppliers account. Okay, good. So let's see. We have credit purchases. So credit purchases is 100,250. Okay, it's 100,250. Good, good. It's 100,250. It's 100,250. Then the it's 100,250. Okay. It's 100,250. 100,250. Okay. Good. So then we have sales on credit. Now sales denotes reselling, okay, on credit. So we'll credit our sales account. We need to debit the debtors. So come into the sales ledger control account, say credit sales. And the credit sales is 135, 720. Good. Then we have payment to credit suppliers. When the business pays its suppliers, the business is going to credit its cash book. So what we do to the suppliers or purchase ledger contract, we need to debit it. Okay, good. So we have payment to suppliers. So we come here, payment to suppliers, and that is 85,000. 85,000. Good. The next transaction checks from credit customers. So if our customers are paying us, okay, we will debit our cash book. So once we are receiving cash, we debit our cash book. So what we do to the sales ledger control account, we need to credit it. Okay, good. So we come here, we say check, receive, checks, check from credit customers. So check from credit customers. Good. And that is 105,150. Okay, good. We have bad debt written off. Now, when a debt is bad and it is written off, what happens? The debt will increase the debtor's balance. So when the debt is written off, okay, we have to reduce it. Okay, and since debtors have a debit balance, anything that increases is with debit, anything that reduces is going to be credit. So bad debt written off will be credited to the debt sales ledger controller. So bad debts, what written off? Bad debt written off is 2,500. Good. Then we have what? Discount what? Allowed. Discount allowed. Now, when we give our customers discount, okay, it also reduces the amount that they should pay us. It also goes to what? Reduce their balance. Okay, good. So we have discount allowed. Discount allowed. And that is 15,000. Good. We have discounts received. Who do we receive discounts from? From whom will the company receive discount? It's only when we are making prompt payment of our debt to our suppliers. Okay, they will give us discounts. When they give us discounts, okay, what happens? It reduces our balance. So we come here, say discounts received. Discounts received. Discounts received. And the discount received is 8,500. Good. Good. Then we have what? Returns inwards. Return inwards. That is when customers return goods to us. Okay. Now that returns comes to reduce their balance, the amount they are owing us. Okay. Good. So we say returns inwards. Then the return inwards amount is what? That is 5,500. 5,500. Good. Then we have what? Returns outwards. That's when we also return goods to our suppliers. Now, when we buy on credit from them, we debit our purchase and credit the purchase ledger. So that increase. When we return goods to them, okay, when we return the goods to them, okay, what do? We credit the returns outwards account. So we need to debit the purchases ledger control account or the suppliers account. So we come here, we say returns outwards. And the return outwards is 6,700. The next thing is balances on the sales ledger set off against balances in the purchases ledger, meaning there are customers who are at the same time suppliers, and then they have agreed to offset their balance. Okay, so here we look at if the balance is decreasing, what do we do? Now in the sales ledger, when debtors balance is decreasing, we need to credit it because debtors have a debit balance. So anything that is debited increases the debtors balance. Whereas in the purchases ledger control account, anything that increases that account is credited. So anything that reduces it must be debited. So we say set off. And the amount we are talking about here is what? 14,000. So we come here and say set off 14,000. Good. Then we have cash purchases. No, we don't record cash purchases or cash sales in any of these two accounts. It's only for credit sales and credit purchases. Okay, good. Then we have sales ledger credit balance at 30th September 2012. Sales ledger credit balance at 30th September 2012, meaning that at the end of the year, the balance on the debtors account, okay, it should be a credit balance. Now, for an account to have a credit balance, it must have a carry down at the debit before it comes down as credit, indicating the balance on the account. Good. So if you say the sales ledger credit balance at 30th September, meaning that the balance carried down on the sales ledger is 5,000 here. So at the end of the day, let's see. what we have on this account. And we can see purchases ledger, debit balance at 30th September 2012. So if the purchase ledger had a debit balance, then it means that it must have a balance carried down here, so that the brought down comes to the debit, indicating what? The debit balance that I'm talking about. So that is 4,500. Good. Good. So let's add up. Excuse me, let me pick my calculator. Okay. Use my phone. Good. So that's the sales ledger control account of 25,400 plus 135,720 plus 5,000. That gives me 166,120. I'm just guessing that this will be bigger than this. Let's total the credits. We have 500 plus 105,150 plus 2,500 plus 15,000 plus 5,500 plus 14,000. So that gives us 142. So obviously the debit is bigger. So we count our balance carried down here. So we have 166,120. Now the credit gives us 142,650. Okay, but we know that in balancing of the bigger side is used as a total for both sides, and we find the difference between the bigger and the smaller side, and the difference introduced as a balance or carried down or the closing what balance. Good. So here we have one. Let me go over this 500 plus 105,150 plus 2,500 plus 15,000 plus 5,500 plus 14,000. That gives us 142,650. So 142,650 minus 166,120. That gives us 23,470. So our balance brought down is 23,470. Good. So let's balance off this account too and see. So the credit gives us 18,250 plus 100,250 plus 4,500. That gives us 123,000. 123,000. Let me look at the debit here. 400 plus 85,000 plus 8,500 plus 6,700 plus 14,000. That gives us 114,600. So the bigger side is 123. So that's the credit 123,000. 123,000. Okay. So the balance carried down, which is 123,000 minus 114,600. That gives us 8,400. Okay. So we see balance brought down, which is 4,500 here. The balance brought down, which is 8,400 here. Okay. Then this will have balance brought down, which is 5,000. Okay, good. So this is the control account. This is the control account. This is how we go about the preparation of the control account. Okay. Okay. The next thing was for us to state two advantages of preparing control account. We know that it helps in allocating of errors and helps in the detection of fraud as well. Okay, good. And it also acts as a check on the respective, the accuracy of the respective data balance or the payable balances. Okay, good. So this was an ICA November 2013 question. Okay, good. So it's very much examinable. It's an examinable area. So you pay attention to it. Okay, now let's look out for another question. Okay. Question 15, it says that the sales ledger control account of PC Limited for the year ended 31st December 2014 has been prepared from the following information. Debit balance brought down 1st January 2014, credit balance brought forward 1st January 2014, total for the year 31st December 2014 to 31st December 2014. So total for the year 1st January 2014 to 31st December 2014. Good. We have the credit sales. We have checks received from customers. We have cash received from customers. We have sales returns from customers. We have discount allowed. We have dishonored checks. We have contract purchases ledger. We have irrecoverable debts. We have sales ledger control account balance, which is part of the double entry system, failed to agree with the total receivables at 189,350 as shown by the schedule of receivables. The following errors were subsequently discovered. 1. A customer had returned goods to PC Limited at the selling price of 2,400. The goods had been bought on credit. No entry had been made to record the return of the goods in the account of PC Limited. Discount allowed column in the cash book had been overcast by 1080. No contract entry had been made in receivables account in the sales ledger in respect of purchases by PC Limited of goods at a price list of 2,000. PC Limited received a trade discount of 10% on these goods. This transaction had been correctly dealt with in the sales ledger control account. Now, a credit sale of 3,520 to JT Limited was correctly recorded in the sales ledger control account, but no entry had been made. No other entry had been made. Now, a check received from a customer for 6,900 correctly processed throughout the books had subsequently been dishonored. No entries have yet been made to record this dishonored check. DT Limited, a customer, has recently been declared bankrupt and debt of this is to be written off, but no entries have yet been made. Prepare a revised sales ledger control account for the year ended 31st December 2014. Then B, prepare a statement showing the correct total of the schedule of receivables for the year ended 31st December 2014. Okay. Then discuss two advantages of PC Limited using the control account. Okay, so you see how the questions are set. So it's not always that you'll be giving the transactions just in the fixed example to just be recording them. There are instances where they'll give you the information and then they request that a revised sales ledger control account for the year ended 31st December 2014. Okay, and we have to prepare a statement showing the correct total of the schedule of receivables for the year ended 31st December 2014. Okay, and we have to discuss two advantages to PC Limited of using the control account. Okay, good. So let's see. Let's look at it quickly. Okay, so to second question. So we have to prepare the revised The revised sales ledger control account. Okay. Good. What company of PC Limited? So we have the revised sales ledger control account. Okay. So if you look at the question, it says that the sales ledger control of PC Limited for the year ended has been prepared from the following information. Debit balance, that is 1st January 2014. So let's bring our balance box forward. 128,540, and the credit balance on that same account is 2,800. Good. So the total for the year, that is 1st January 2014 to 31st January 2014, we have credit sales 1,144,200. So now we have to go through the other notes to find out whether there were any credit sales that were not recorded during the period. Okay, good. So let's go through and see. We have the sales and control account, which is part of the double entry field to agree with the total receivables of 189,380 as shown by the schedule of receivables. The following errors were subsequently discovered. A customer had returned goods to PC Limited at selling price of this. These goods had been bought on credit. No entries had been made to record the return of the goods in the account of PC Limited. So now this one affects returns inwards. A discount allowed column in the cash book had been overcast by 1080. So it means that the discount allowed here must be reduced by 1080. Okay. We say no contra entry had been made in the receivables account in the sales ledger in respect of purchases by PC Limited of goods at price list of 2,000. Now, PC Limited received a trade discount of 10% on these goods. This transaction had been correctly dealt with in the sales ledger control account. So meaning this one will affect the debtors account, there's a receivables account, okay, not the control, because in the control account, the effect has been treated. Good. Good. Let's see. Let's continue. Excuse me. A credit sale of 3,520 to JT Limited was correctly recorded in the sales ledger control account, but no other entry had been made. So it means that in the control account was captured, but the JT's account, there were no record. That's the receivables schedule account or the receivables account. Okay, but in the total account, it was captured. So this does not affect the revised control account. Okay, take note. A check received from a customer for 6,000 correctly processed through the books had subsequently been disbanded. No entries have yet been made to record this disbanded check. A check received from a customer for 6,000 correctly posted through the books, okay, had subsequently been disbanded. No entries have yet been made to record this disbanded check. Okay, so when a customer pays his check, we go what? Debit our cash book and credit the sales ledger control account. Now, when the check is disbanded, it means that we have to come back and restate the debt. Okay, we have to come back and restate the debt. So when the check is disbanded, we have to debit our account. Okay, we need to debit our account. Good. So if that has not been done, we need to what? Do it. If that has not been done, we need to do it. Good. Then the last one is that DT Limited, a customer, has recently been declared bankrupt and the debt of 3,000 is to be written off, but no entries have yet been made. So it means that now this transaction has not been recorded either in the sales ledger control account or in the individual receivables account. So we have to enter both transactions. Good. So from here, we can see that the only credit sales affects the sales receivables account only, not the sales ledger control account, because we are told that the credit sale of this to JT Limited was correctly recorded in the sales ledger control account, but no other entry made. So the sales ledger control account is correct. So here our sales for the period, our credit sales for the period still remains the same. So we come here and say credit sales of what? 1,144,200. Good. Good. Then we have check received from customers. So checks received from customers. Okay, good. So let's see whether there were any receipt of cash that was not recorded. So this is returns. This discount allowed. This is check received consistent correctly posted through the books. Posted through the books had subsequently been discerned and no entry have yet been made to record this discerned check. Okay, so the check was recorded, but now it has been discerned. So it means that check received from customers to the nothing was none of the transactions here affected it. Okay, so we come here and record our check received. That's 1,046,200. Good, good, good. Then we have what? Cash received as well. So we have cash received from customers. Okay, now, was there any of the subsequent transactions that affected cash? This is returns, this discount allowed, this credit sales, this is check received from customers, this is detail limited a customer. Good. So there was nothing affecting that. So cash received from customers was how much? Cash received was 7,100. 7,100. So that is unaffected. Good. Good. So let's see. Sales returns. Sales returns also reduce the debtors balance, because when the debtors return goods to the business, okay, we debit it. So we need to reduce their balance because the goods have been returned. So sales returns. Sales returns. So let's see. So a customer had returned goods to PC Limited at the selling price 2,400. These goods had been bought on credit. No entries have been made to record the return of the goods in the account of PC. Good. So it means that the returns that we have here is 12,000. It's 12,000. Okay. So we add the 2,500 to it. Okay. Good. Good. Oh, sorry, 2,400 instead. It's 2,400 plus 2,400. Great. Great. Any other returns? This discount allowed. This credit sales. No contract entry. This checks received. This, okay. So that gives us 14,400. Good. 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 The next thing is what? Discount allowed. Discount allowed. And this discount allowed is cash discount. Okay, cash discount allowed. Good. So let's see. Discount allowed column, the cash book had been overcast by 1080, meaning that the discount allowed that was captured in the previous sales ledger control account was overstated. So what do? We need to deduct. So we pick that one, which is 2,480 minus 1080. Okay, minus 1080. Now let's go through to see whether there were any transactions that affected discount allowed. So yeah, so no entry had been made in the resale account in the sales ledger in respect of purchase by PC Limited of goods at a less price of this. PC Limited received a trade discount of 10% on these goods. This transaction had been correctly dealt with in the sales ledger contract. So in the sales ledger, it had been correctly recorded. So there's no issue there. And even the discount offered, it was a trade discount, so that does not have any bearing on this. Credit sale of this correctly into the sales ledger control account. Check received from customers. Okay, so no other transaction affected the discount allowed account. So here we have 2480 minus 1080. This is 0, 0. This is 4. This is 1. So we get what? 1,400. We get 1,400. Good. 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 Let's move on. The next transaction is what? Dishonored check. Now, when we receive cash from our customers, we saw that it was credited to this account. Checks, it was credited. Now, when the check is dishonored, it means that you have to bring back the debt. Okay, so you come here and say dishonored. Dishonored checks. Good. Now, already we have dishonored checks of what? 5,000. Okay, plus. Now, let's see whether there were others. Now, a customer had returned goods, so we have recorded this. Discount allowed, column the cash book had been overcast by that. No contra entry had been made in receivables. Okay. Credit sale of this was correctly recorded in the sales ledger of column, but no other entry made. A check received from a customer for 6,900 correctly processed through the books, but subsequently been dishonored. No entry have yet been made to record this dishonored check. Good. So means that we have to add that dishonored check to this one. So 6,900. So 5,000 plus 6,900. Good. Good. So what do we get? So we get 11,900 for dishonored checks. Good. Then we have what is called irrecoverable debt. Okay. Irrecoverable debts. Okay, first let me talk about the contra purchases ledger, meaning that there are some suppliers who are at the same time our customers, and they have agreed to offset the balance owed them. Okay, good. And so here we come here, we say set off. Now the amount in the old sales ledger contract account is 10,640. Okay, plus now we're told that the company did what? No contra entry had been made in the receivables account in the sales ledger in respect of purchases by PC Limited of goods at a less price of 2,000. The PC Limited received a trade discount of 10% on these goods. This transaction had been recorded correctly in the sales ledger control account. Good. So that will not have any effect on the control account because the transaction has been recorded correctly in the control account. So that will not affect this control account. So we have our set off, meaning that the amount of set off is included in this contract balance of 10,640. Okay, good. 10,000. Let me make it clear. 10,640. 10,640. Okay. Okay. Then we have what? Irrecoverable debt. Irrecoverable debt. Irrecoverable debt. Good. Now, irrecoverable debts in the old receivables ledger contract as 6,500. Let's see whether there were any. Customer had returned goods. This is returns. This is discounts allowed. This is contra. The credit sale of 13,000. This is the contract. Another entry. A check received from a customer for this process through the goods has been discounted. DTL Limited, a customer, has recently been declared bankrupt and debt of 3,500 is to be written off, but no entries have yet been made. So if there's no entry, it means that you have to go and credit the individual customer's account and also credit the control account. Good. So the irrecoverable debts per the old is 6,500. So we add 3,500 to it, and that gives us 10,000. Okay, that gives us 10,000. So at the end of the day, there's the need for us to extract the difference on this account. Okay, there's the need for us to extract the difference from this account. Good. Give me a second. Let me look for my calculator. Okay, I've grabbed my calculator here. Good. So let's see. These are sales ledger control accounts. So let's add. We have 128,540 plus 144,200 plus 11,900. That gives me 1,284,640. Okay, 1,284,640. Let's look at the credits. We have 2,800. Okay, we have 2,800 plus 1,046,200 plus 7,100 plus 14,400 plus 1,400 plus 10,640 plus 10,000. That gives me 1,092,540. So the total is 1,284,640. 1,284,640. Now this minus 10,92,540. So that gives us a balance carried down of 192,100. So what this means is that our balance on our sales account, okay, our sales account or receivable, the balance on our receivables account should be 192,100, meaning when we add the individual debtors balances, we should get 192,100. But in this question, the debtors balance was what? 189,380. It was 189. That's with the total receivables of 189,380. So now we must prepare a schedule to correct this receivables totals. Okay, so how do we go about that? So let's see. So let's look at the revised receivables. Find out what. Prepare a statement showing correct total of the schedule of receivables. So a statement showing the correct total receivables. Okay, good. So here we bring the balance brought forward, which is 189,380. Okay, now what it means is that anything that would have increased it, that wasn't recorded, we have to add it. Anything that would have reduced the debtors balance that they didn't record, we have to record. So let's pick the entries one after the other. So the customer had returned goods to PC Limited at the same price total. These goods had been brought had been bought on credit. No entry had been made to record the returns of these goods in the account of PC Limited, meaning that they were not recorded in the books at all. So this returns needs to be what? Recorded. So say returns inwards. It wasn't recorded, meaning that it didn't have effect on the control account nor the individual debtors accounts. Okay, so you can see that in the control account, that returns was also what's added. Sales returns of 2000 was added. So it means I have to come back. It was deducted from the sales ledger control account. So you have to come back and adjust it. So that 2,400 will be deducted. Good. Then discount allowed column in the cash book had been overcast by 1080. Now, if it was overstated, it means that it led to a reduction in this balance unduly. Okay, this balance was understated, because if you overstate discount allowed, meaning that the debtors balance will reduce unduly, so you have to add back. So you see discount, let's see, but let me see, okay. Discount column in the cash book had been overcast, yes, so it will cause a reduction in this balance. So we add discount allowed of 1080. Good. Then we said that no contra entry had been made in the receivables account in the sales ledger in respect of purchase by PC and that goods at a less price of this. PC Limited received a trade discount of 10% on these goods. This transaction had been correctly dealt with in the sales ledger control account. So if that has been correctly dealt in the sales ledger control account, what's the implication? What's the implication of this transaction? Good. Now, if they have received a discount of 10%, meaning that PC needed to pay just what 90% of it. So that is what a contra entry, and that contra entry will also come to reduce that what balance. Okay, good. So we come here, we say contra. So it's 2,000 times 90%. 90% because once a trade discount of 10 has been given, meaning the PC Limited has to pay for 90% of it. Okay, so 2,000 times 90%, that gives us 1,800. Okay, that's a contract to come to reduce it. Good. A credit sale of 3,200 to date was correctly recorded in the sales ledger contract, but no other entry had been made. So this credit sales will also come towards add up to the debtors balance. It wasn't recorded in the books at all. Neither was it recorded in the individual customers account nor in the control account. So in the control account, sorry, it was recorded in the control account, but no other entry was made, meaning that in the JTL Limited's account, it wasn't recorded, but we recorded in the sales ledger. That's the total debtors account. Good, but it wasn't recorded in detail, so it needs to be adjusted to the receivables balance here. So we see credit sales of what? 3,520. Good. Good. Then we see that a check received from a customer for system correctly processed through the books have subsequently been no entry have yet been made to record this dishonored check. So we have to record it here as well. So dishonored check will come and add to the debts, which is 6,900. 6,900. There's a detail limited. A customer has recently been declared bankrupt, and the debt of the is to be written off. No entry has been made, so that's a bad debt. Bad debt written off. Written off. It will come to reduce this balance as well. So 3,500. So let's add up and see. So we have 189,380 minus 2,400 plus time 80 minus 1,800 plus 3,520 plus 6,900 minus 3,500. Okay, what do we get? One 189 380. Sorry, 189 380 minus 2,400 plus 1080 Let's see. Here's the 1080. Plus 1080 minus 1800 plus 3520 plus 6900. Okay. Minus 3500. So that gives us 192,100. Okay, good. So this is to be done to reconcile the good. Good. So let's see something here. The discount allowed column in the cash book had been overcast by 1080. So this overstatement happened in the cash book. Okay. So what it means is that now in the total receivables account, okay, or the sales ledger contract, we'll pick our discount from the total discount. Okay, the total discount. So it's a total discount that has been overstated. Okay. However, for discount that were offered the various customers, every customer will take his discount. Okay, good. So what it means is that this discount allowed affects only the what's it called, the totals, because in the cash book, when you want information about discount allowed, it's the total in the cash book that will be picked and sent to the sales ledger control account. But as a customer is offered a discount, the customer will take it. So that's why I'm saying that the discount allowed column in the cash book had been overstated. So it means that the total discount was overstated, but the discount per customer, nothing affected it. So take note of that statement, okay, carefully. Because if you include the 1080 here, you will get 193,100, 193,100, and that wouldn't agree. So that needs to be adjusted here. Good. So the debt rating of was 3,500. Good. So we less that one. So we have 189,380 minus 2,400 minus 1,800 plus 3,520 plus 6,900. Okay. Then minus 3,500. Good. That gives us 192,100. Good. Good. So it can be a bit tricky. So you need to have a comprehensive idea, because since the discount column in the cash book had been overstated. So if the discount column has been overstated, it means that in entering the transaction, the sales ledger control account is the total of the discount that we pick. But as a customer is offered the discount, the customer takes it. So once they have not indicated that it also affected the total receivables account, you do not adjust it. Okay, it's affected only the sales ledger control account too, because at the end of the day, the total receivables must agree with the sales ledger control account balance. So here you can see we have 192,100 and 192,000. Well, also here. Okay, good. So this is how the control account works. And that was a May 2016 question. Okay, good. Good. Now let's see. Let's take another question. So we have other examples here I'll share with you for you to try your hands on them. Okay, so let's look at example 8. Example 8. Let's look at example 8. Okay, let's look at example 8. So we have MYF Ventures. Okay, it's a wholesaler / retailer of general goods. He sells on cash and credit to his numerous customers. The following information is extracted from his books for the month of September 2014. They have purchase ledger balances, credits, purchase ledger balance debits. They have purchase ledger balances, debits. Sorry, sales ledger balances, debits, and sales ledger balances, credits. Then we have transactions for the month has been given us. Then they're required. We have to write up sales ledger control account and purchase ledger control account for the month of September 2014. Good. So let's see our sales ledger control account is here. And we have the purchases ledger. Okay. So let's look at the transactions of the purchases ledger of balance brought forward. Balance brought forward. Purchase ledger credit balance is 50 million. So I've put million on top, meaning all the thing we are doing is in million. Okay. All the transactions recorded here will be million. Then the debit balance is 10. For the sales ledger, our debit balance brought forward is 70. Our credit balance is 30. Good. Then discount allowed is 30. Discount allowed comes to reduce the debtors balance. So discount allowed 30. Now discount received. Discount received reduces the purchases ledger control account balance. The discount received is 11. We have cash received from debtors. Cash received comes to reduce the debtors balance. So cash received of 440 from customers. Then check received from debtors. So check received from debtors, that is 925. That's 925. That's 925. Okay. Then we have cash refund to customers who has overpaid his account. So when there's a refund to customer, it comes here. So we see cash refund. Okay. Cash refund to a customer who has overpaid his account. That is 2 cedi. Then we have cash paid to creditors. So when the cash is paid to creditors, we credit our cash, so we need to debit. So see cash paid. Cash paid to creditors. That is 845. Then we have a check check paid. Check paid of 240. You have bad debt written off. Bad debt will reduce the debtors balance, so bad debt written off. Bad debt written off 16. You have returned inwards. Returned inwards reduce the debtors balance, and the return inwards is 25. Okay, we have return outwards. Return outwards reduce the suppliers balance, and the purchases ledger balance, that is 40. We have dishonored checks. Dishonored checks. So dishonored checks. That is 35. Dishonored checks. That's 35. So let's check that 35. Then we also have what set off against balances in the sales ledger. Set off. So set off reduces the debtors balance and again reduces the creditors balance. So the set off is 10 here, 10 here. Good. Now, if you look at our format, okay, let me try and show you something here. If you look at our format, you can see that in the sales ledger account, when there's a dishonored check, okay, it is what? Debited. And when there's a dishonored check, it is credited under the payables. Okay, good. So here, the dishonored check, they didn't indicate. Okay, they didn't indicate. So here, what do you do? Where there's only one dishonored check. Okay, good. So here, most often than not, it's better that you state or you assume that, okay, the check were checks received from customers which were what dishonored. Okay, good, because it's hardly that the business issue checks and the check will bounce. Okay, good. That's why I've entered it under the sales ledger control account, meaning the checks were received from customers has bounced. Okay, good. Then we have the set off has been recorded. Then at 30th September 2014, sales ledger balances was what? 50. The sales ledger balances was 50. And the purchase ledger balances was 60. Now, ordinarily, okay, debtors have a debit balance. So everybody will assume that if there's a balance on it, then it should be what? A credit balance. Okay, good. It should be a credit balance. Okay, because if you look at this account, there's no credit what? Sales. If you look at this account, there's no credit sales. So your balance carried down from the sales. So once they state just balance, you assume that debtors have a debit balance. So the balance carried down needs to be at the credit side. Okay, 50. So here, this is what we have. And the purchase ledger is 60. So everybody assume that the purchase ledger will have a credit balance. Okay, so the balance carried down comes here 60. Okay, and here too, you can see that the debit side, there's no credit purchase. So here the intention was for us to define credit sales and credit what? Purchases. Good. Good. Because you have the opening balance, you have the closing balance, you have transactions during the year. So the essence is for you to find your what? Your credit sales and credit purchases respectively. Good. So let's see. On the credit side, we have on the sales, we have 30 plus 30 plus 440 plus 925 plus 16 plus 25 plus 10 plus 50. That gives me 1,526. 1,526. Okay. So the difference here should represent our credit what? Sales. Good. So 1,526 minus 70 minus 2 minus what? 35. That gives me a credit sales of 1,419,000. Okay, good. So let's look at the purchases ledger. We have 10 plus 11 plus 845 plus 240 plus 40 plus 10 plus 60. That gives me 1,216. 1,216 minus 50. So we get credit purchases of what? 1,166,000. Okay, good. Good. So this is another way that a question could be asked. So we can see that in the previous example, we're given the amount of credit sales, credit purchases, and therefore we're looking at the closing balance. In this very question, we're given the opening balance and we're given the balances at the end. Now, the balances at the end, nobody should tell you what balance it should be. Once they say sales ledger balance, everyone knows that sales ledger balance talks about debtors, and debtors have a debit balance. So the brought down indicates that it has a debit balance. So balance brought down for 50. Okay, then the creditors have credit balance. So the balance brought down will indicate that it's a credit. Okay, good. And so the essence was for us to find our credit sales and our credit purchases. Okay, so when the opening is given, closing is given, and the current year transactions are given without the credit sales or credit purchases, it means that when you finish, the difference on the account should represent either your credit sales or your credit purchases for the sales ledger control account and the purchase ledger account, respectively. Happy together. Good, good, good. So this is how control accounts are prepared. This is how control accounts are prepared. Good. So I'll share the lecture notes with you later. There are a number of questions in there. You have to try your hands on them. If you are challenged in any way, please do not hesitate to contact me. Okay, and I'm more than happy to assist you. Keep on keeping on. At the end of the tunnel, we will all be smiling. Do enjoy the rest of the day.